Do we do market timing? This is Bill Scheid from Applied Finance Research, and that's the question we're going to take a look at in this video. It's a question that we sometimes get about our monthly asset allocation systems. People ask, is this market timing? So let's take a deeper look. To begin with, let's define market timing. This is something that I had to look up myself, as I've never actually researched market timing before. I've certainly heard the term a million times, and I've heard retail investment advisors talk about it quite negatively, actually, using tropes like it's not timing the market, it's time in the market, etc., etc. But I never actually looked into the definition. So here's what Investopedia says about market timing. And there are some interesting key takeaways here, and I want to highlight a few important points. First of all, they say it's based on predictive methods. Second, they say it's the opposite of a buy and hold strategy that doesn't account for volatility. And third, they say it's difficult for the average individual investor. Finally, they conclude that there are good reasons to avoid market timing and focus on investing for the long run. Now, what do we do? Let's look at some of the key takeaways of what we do. So first of all, our monthly asset allocation systems allocate capital in a portfolio to specific financial markets based on academically rigorous market concepts, systems thinking, and statistical analysis. Monthly asset allocation systems are neither market timing nor buy and hold, and they offer investors a third option that is in fact volatility adaptive. Monthly asset allocation systems are easy for the individual investor to understand. They are simple, time efficient, and can be applied in even the most restrictive retirement accounts. In terms of time efficient, you can execute these systems in literally under an hour a month. And if you've got a retirement account where your fund choices are limited by your employer, for example, or you can only rebalance, let's say once a month or once a quarter, you can still execute these systems. For the average investor who doesn't have the time or desire to watch the market daily, there are good reasons to avoid market timing and buy and hold and focus instead on monthly asset allocation systems. So let's compare market timing to monthly asset allocation systems in a side-by-side basis. So while market timing is based on predictive methods, monthly asset allocation is based on academically rigorous market concepts that have been well researched for decades in the academic literature. It's based on systems thinking, and it's based on statistical analysis. In my experience as an investing researcher, as a trading systems researcher, I am in fact highly skeptical of any market approach based on predictive methods. I've actually not seen any methodology based on prediction that actually works. While Investopedia says that market timing is the opposite of buy and hold that doesn't account for market volatility, monthly asset allocation is neither market timing nor is it buy and hold. It's actually a third option, and it is volatility adaptive. Now, why is it important to be volatility adaptive? Well, here are two reasons among many. First of all, psychologically and emotionally, it's very difficult to be a buy and hold investor in major bear markets. To sit there and watch your account take a big hit and pray that it will come back one day, hopefully, maybe in the future. In contrast, our systems use volatility as a key market indication to move out of equities. And because we use volatility, because we are volatility adaptive, our systems avoided the subprime mortgage crisis in 2008. We were actually out of equities at that time. And we also avoided the COVID crash, along with several other major bear markets along the way. The second reason being volatility adaptive is really important is that avoiding large drawdowns is not only easy on the mind and emotions, but it's one of the keys to long-term outperformance. We get to keep the gains that we previously made before a bear market instead of seeing them get wiped out. And then we compound those gains when favorable market conditions return and we rotate back into equities. Now, back to our comparison, Investopedia says market timing is difficult for the individual investor, whereas in comparison, we've taught monthly asset allocation systems to average and even beginner investors with great success. Because the systems are simple, they don't require in-depth fundamental or technical market understanding. You can learn the basics in a half-day workshop, and they take less than an hour per month to operate. Investopedia says there's good reasons to focus on investing for the long run. We say there are good reasons to focus on monthly asset allocation systems, not the least of which are the facts that they consistently outperform the markets, sometimes by a factor of 10 to 1. And for more information on that, see any of our videos on our system results. Number 2, they avoid major bear markets. Number 3, they're robust, meaning that they offer consistently solid performance across a wide variety of markets and historical periods. And finally, they're flexible, so it's easy to customize these systems to fit your risk tolerance and growth objectives. For more information on building your own configuration of these systems, please see our YouTube video on that topic. So in summary, the answer to the overall question is no. What we do is not market timing. Neither is it buy and hold. Monthly asset allocation systems offer a third objective that has a number of edges and advantages over both market timing and buy and hold. Thanks for watching. This is Bill Scheid from Applied Finance Research. Happy investing.